What lemonade stands can teach you about accounting. My daughter Sydney and I had a great weekend selling lemonades the entire weekend, and she was squealing with delight. She had just told me that she made $200 of sales, incurring $100 of expenses, $100 of profits. She had never seen money like this in her entire life. She was thrilled. She was a born-again entrepreneur. 1 week later, the following weekend, I sat down with her and I said, let's gonna run the numbers again, okay? And she was very excited about it, and I said, I got some bad news for you. You not only didn't make $100, but you lost money. And she heard, I've only seen that expression once before. I'm a financial advisor in real world, and I see CEOs get this news from CFOs that usually tell them you're running out of cash. And invariably the CEO says to the CFO, wait a minute, either last year or last month, we made a lot of money. $1 million, $100,000, we made a lot of money, but they make a reference to their profit and loss statement making $100. And the primary difference here is the difference between the income statement and the cash flow statement that I needed to explain to her. Okay, I didn't use it in those terms. So there's basically 5 changes we had to make. Number 1, and most importantly, was she had thought she sold $200. Well, in fact, she sold $175 and got $175 of cash, and she had $25 of promises from her friends that they would pay her. That Monday she tried to collect, they didn't have the money. Tuesday they forgot the money. Wednesday they forgot the money again, and she quickly realized if she valued their friendship, she would have to write off that $25. So her sales were not $200, but only $175. I explained to Sydney that, not collecting all your sales is something that happens in business regularly. And she didn't quite understand that, but most of us in business know that you're going to have to write off a certain amount of your expenses. Her case it was $25. Now let's look at the expenses, okay? And what ended up happening in expenses is that I reminded her that what I had to do was, in the middle of the sale, I had to go out and buy additional oranges. And so those were late bills. They came in after the weekend. So her period that she was valuing was Saturday and Sunday. What I was doing is I was extending it past Saturday and Sunday to the following week. Okay? So those bills came in. I reminded her that I had purchased $20 of extra inventory, and that had to be an extra expense. She was unhappy, but she still figured she needed more. She was going to have more money. I then reminded her that before the weekend started, I went out and I bought $15 of inventory, primarily lemons and oranges. Okay? Now that was purchased in Friday, well before the measuring time period. But just like in business, it all depends on the period. Most businesses, when they're valuing it, when they're looking at a profit and loss statement, they're looking at a full year. So it may not seem that important. But rest assured, if you're heavy into sales and expenses in Christmas time, it makes a big difference. So her period, I extended from 2 days to now 8 days. A day before the sale and 7 days after the sale. So extra expenses that were expended before the weekend had to be included. That was $15. The other thing that I reminded her is that I had purchased a lemonade piece of equipment. It was a squeezer, but it was automated. It made squeezing lemons much more efficient. We were very, very efficient. We could shoot out a lemon and an orange in a matter of less than a minute. It was great. The only problem is, after the weekend was over, we had no interest in this piece of equipment. And I say we. She had no interest, and I had no interest, okay? And so we needed to expense that piece of equipment. Now she said, wait a minute, that piece of equipment is still good. We only used it for the weekend. Why do I have to pay for it? You take it, you use it. And I explained to her I had no need for it anymore. And so that investment that we made in equipment had to be written off for the weekend. And this happens in business all the time. Equipment purchases that you make, investments that you make, that you think is going to last a long time, sometimes only lasts a weekend. Okay? And so in that case, that piece of equipment of $25 had to be expensed. Okay? So you can see our expenses are now adding up. And lastly, and this is a classic, if you ever think about going into a supermarket and seeing that fruit that looks like it's just about to turn brown, whatever happens to that inventory? Well, guess what? The supermarket writes it off, throws it away. We had lemons. They weren't browning, but we had lemons. But the bottom line was the next sale we're going to have was going to be in weeks, if ever. Okay? And so that inventory that we had left over, although it was valuable, we had no value for it. And so I explained to her we had to write off all of those lemons. It was about 3 dozen lemons that we had to write off. Okay? So that's leftover inventory. So now when you look at it, we had $25 less sales, the $25 that we couldn't collect. We had extra expenses. The extra expenses came in the form of late bills that came in after the weekend, the bills that we paid before the weekend, okay? Equipment purchases that frankly after the equipment was made couldn't be used anymore, so we had to write off that equipment. That was $25. And then the leftover inventory that frankly we had to write off. Okay? So when you add it all up, you got $80 of extra expenses, $25 of less sales, and all of a sudden that $100 profit turns into a $5 loss. Well, you can imagine this accounting lesson was very, very important for her. She basically learned the difference between accounting and cash flow statements. Okay, so is counting important? Well, ask any entrepreneur. And the only thing that I'll say is more important than accounting when an entrepreneur is measuring their success is a cash flow statement. Thank you for learning about cash flow statements.